All right, guys, welcome back to the channel. It's been a little bit of a hiatus here. Actually, I had COVID-19. I started feeling symptoms on December 16th, so I am on day 11. We're December 27th today. Yeah, it really knocked me out of commission. The worst of it was the sore throat. It was like like a knife in my throat every time I would swallow, and that lasted for a long time. It's the worst I've ever been sick, without question. The throat has turned the corner. The only thing left, and you'll hear it a little bit, is a little sort of altered breathing and a cough that's still here. So I may cough a couple times throughout this video. I apologize, but I miss doing these videos, and now that I feel a little bit better, I kind of wanted to get back in the saddle. So that's the first order of business, just, COVID-19, day 11. The second thing, I woke up this morning and I saw this email from Lee Joy John from Seeking Alpha, announcing that they're actually discontinuing blog posts. So for those of you who follow my channel, you'll know that I started writing monthly essays on Seeking Alpha from May 19 on. I actually joined Seeking Alpha in 2017, but I started tracking my investments from May 2019 till now. So I'll try to continue that on maybe Medium is a place that other people recommended. Any other recommendations, let me know. But to be frank, I put much more of my energy now into the YouTube channel, as opposed to the Seeking Alpha monthly letters. I'll still do it. I still enjoy it. Kind of tracks it, for the Maneos compounding machine and such. Yeah, I think what he says here, effective today, we are withdrawing the blog posting option. Seeking Alpha blogs are usually investment related posts that are broadly relevant to readers and therefore may have direct investment implications for them. As you may be aware, blogs are published without editorial review and approval and thus carry inherent reputational risk. Our readers expect a certain credibility and accuracy from all Seeking Alpha's published content, and we want to ensure that all ideas are curated and reviewed prior to publication. Yeah, I think what they're trying to do is really control liability. Pretty much anyone can go in there and say anything they want. And so, if they're analyzing things and they're presenting false data, that could be a problem. For me, with the Seeking Alpha thing, what I do is a lot different. I track my own investments, so it's sort of investment voyeurism. It's not analysis. So my close friend Logan Kane, very talented writer for Seeking Alpha, he does analysis. So he might do an article that, on Home Depot versus Lowe's, or Pepsi versus Coke, or Chevron versus ExxonMobil, so on and so forth. And then that writer, whether it's Logan or someone else, would present data arguing the point that perhaps Chevron is a better allocation of capital than ExxonMobil, or vice versa. That's not what I do. I'm at a point where I'm just kind of tracking my investments, allowing those to follow along, to see the successes and failures that I have along the way. Yeah, at this point, I'm worth a couple $1 million, trying to go from lower Richistan to middle Richistan. For those of you who read the books of Robert Frank, you'll understand that reference. And but yeah, so we'll see. Like I said, I'll continue on Medium, with my monthly letter. Let me just show you here. I'll actually change screens now, and we'll actually go to Seeking Alpha. So this right here, so you can see, like, I've been a member since 2017. It links to the Maneos compounding machine, my LinkedIn. You can see the last letter, November 2021, and then obviously this one, Composer, launched. And then you see, going back every month, this is in June, I crossed $1 million. In May, it was a 2-year anniversary of my letters. And just going back, and going back to, see, May 2019 was the first kind of monthly letter. And yeah, so it's been fun. I like Seeking Alpha a lot. I'll still use their site for my own purposes. Maybe they'll reverse something like this and allow a select few to publish, maybe not, and that's fine too. So let's go in just to kind of go into the portfolios here and just kind of portfolio update towards the end of the month. So you can see in TD Ameritrade here, right now, capital 638, almost 639. What's interesting is this particular account peaked like November, I think 3rd here. Let's see, 661, November 2nd. Yeah. So Wednesday, November 3rd, this account reached almost 670,000. So you can see that's a good, $30,000 since the beginning of November. We've had some sell-offs. I mentioned Logan Kane earlier. I kind of often say this to him on our own private conversations. I say we've sort of been in the markets, volatility on the pathway to nowhere, because we've kind of been in that 34 to 36,000 range. There will be an Omicron variant or something that causes a big sell-off, maybe what the Fed's going to do, what have you. And so markets sell off a couple thousand points, something happens, maybe Omicron is mortal as Delta and others, and so the market responds positively, and we get in that 35, 36. So it'll be interesting to see kind of where we go from here. We're at 36. Are we going to kind of just play the same game and there'll be a 1,000 or 2,000 point sell-off? Will we accelerate on the path to 37 to 40,000, or will we go into a bear market and really pierce that 34,000 and really go maybe 32, 30,000, what have you, into a true bear market and a big sell-off? We'll see. So that's that. The other thing I want to show, and this always happens in December, which is nice, and that's why I did that one video where I say, every day I'm getting richer and richer, even when days when I'm hemorrhaging $10, $15, $20,000 of capital. Let's just look at like the last 14 days in transactions, and let's go just dividend. Just, the end of the year, a lot of companies are issuing pretty significant dividends. So this is going to go from the 13th. You can see DIA $17. This is a Schwab ETF 14. PCI, it's PIMCO, $9.57. MetLife, $26. CTT, that's a Timber REIT, I believe, 7 here. Tyson, I'm actually right now a lot of my value screens, Tyson, Allstate, and Unum are showing up in a lot of different value screens. And so that's nice that I kind of did a repurchase there, essentially. Stag, a lot of Seeking Alpha writers also like Stag right now. They like Stag and EPR. I can feel a little cough coming here from my COVID-19. There it is. Hopefully I don't have a coughing spell. But let's see. So we have Realty Income, 886. UBOT, 2271. DRN, which is a leverage ETF, 25. Wow, Prudential, $53 bigger dividend there. So again, I'm just going, UWI, $15, CNY. And these are the last 2 weeks, $89 for my Russia, iShares Russia, eRus. Did a video on that a while back where I said, are Russian stocks a good counter to inflation? Because a lot of them in their index are oil and gas, gold mines, nickel mines, diamond mines, all kind of real assets. So, and then the valuations aren't as steep as what you're getting in the U.S. So, you can see a nice big, almost $90 dividend there. And again, just quick scroll, $59 dividend. BP, $22.15. VPU, $10.91. 637. We got SDY here, 1111. PFF preferred shares. Good old Carl Icahn, or as he's known, Genghis Khan, right? The great Carl Icahn gave me a nice check for $74.76. Always had admiration for Carl Icahn. And CP, $63. I mean, it just keeps going. I'm keep scrolling. There's more and more money, free money coming. XLE, that's energy. I bought that in the great panic of 2020 in the sell-off. VWO, I think that's emerging markets. A lot of Chinese stuff in VWO. 13. CN today is China, 970. I guess this was a sale here. I don't know if that's discontinuing. This is the Chinese ETF, $9.70. So again, and I will tally this up at the end of the month. for the monthly letter, which I assume now will be on Medium. But you can just see, like, at the end of the year, all these things are just shooting off dividends. It's a beautiful feeling, whether the market's selling off, the market's going up. So yeah, let's just take a quick little portfolio just on the three main accounts. So it's not going to be all, for those of you who follow, I have the three main accounts. And then I have about 35, 40, and some smaller accounts. So let's just see on the three main accounts where we are here. So we're going to do 639, 31572. And we are going to go now to Alpaca, which is all my composer strategies. So we are 153, 104. Okay. Now, what's interesting here is my cost basis on in Alpaca is 152,000, so I'm up $1,300 or so. But what's fascinating is, I started it, and that's when the sell-off happened. So I think I was down. Let's see if we can, like 143 at some point, 145. Let's see, yeah, 144 was the low here, 146. So yeah, the low looks like 144. No, look, we're 154. 150. So let me start over here because, well, it's close enough for now. We'll just keep it. But yeah, so definitely doing much better here in Alpaca. And even, to the point here, we're going to scroll and make the screens a little lower here. And you can see activities. Even in this, I'm getting some nice dividends. Like this is, a $7 dividend on the 22nd, $8 dividend VXUS in the 22nd, $1.32, 488, 385. So, some nice dividends are coming off there. So let's go to the third main account. And there we go. And this is kind of, I'm going to do the tally here, and then I want to do the final point, which relates to modern portfolio theory. 578 and 46. So 1.216998. So 1.2 million, about 16,000. On the other accounts, let's say there's approximately 40,000. So about 1256. I think I was at 1231. So maybe I'm up 20,000 or so for the month. If that holds, we'll see. We'll see the next week or so, the next few days actually. So this is something interesting here, and it relates to modern portfolio theory. So I just want to scroll up here. What I'm showing you in interactive, return and risk, and it's 1 year time weighted return. And so it's my particular account. I'm going to highlight here. This is SPY. So over the last year, this is the return, the 1 year return of SPY. These are my three accounts in Interactive Brokers, which tallies up to 424. You can see that my return over the last year in this particular account is 46.90%. That doesn't surprise me. This is the account where I run my balanced alpha all weather, and then a third account in there, which is just some kind of random holdings that got transferred over from Motif and Folio, and I've just kind of held them. But look at the max drawdown. My account, the max drawdown is 17.58, and SPY's max drawdown was 5.11. And it's showing, I guess, peak to valley, I guess, when that occurred, and SPY that occurred in September 2nd to September 4th, and the peak to valley in my particular account is 211 to 34. Now, this is interesting here. So we're going to scroll down a little more so you can see it, the Sharpe ratio and the standard deviation. Now, SPY Sharpe ratio is 2.07. Mine is 1.60. Standard deviation, 0.8 and 1.61. Now, many people with a CFA, with an MBA, many people that are practitioners of modern portfolio theory would sit here and look at this and say, well, SPY has a higher risk-adjusted return. This is the investment manager, or this is the fund that you would want to follow. But I would defer here to Warren Buffett, and I use this quote a lot, and I think it's very apropos in a situation exactly like this. And Buffett says, I would rather have a lumpy 15% return than a smooth 12% return. And so what is he saying there? So essentially, I'd rather have a lumpy, meaning more max drawdown, 17.58, a lower Sharpe ratio, a higher standard deviation, 46.90, than a smoother 29.75. And the reason being, I think, is at the end of the day, it's who ends up with the most capital over the long term. Whether it's 10 years, 15 years, 20 years. So you can have a higher Sharpe ratio, Sortino, Calmar, lower standard deviation, but a few percentage points over the long term, for those of you who follow this channel, or pretty much any finance channel, you're going to show you the power of compound interest. They're going to kind of, pull out the compound interest calculator and show you that, 1 or 2 percentage points over 20 years means hundreds of thousands, if not millions of dollars. So just to give you an example here, if someone invested $100,000 in SPY or into my holdings here, right now they'd have 146.9 or 29.75, or should be 129,000. So let's just say it's a 29% return and a 46. So 146,000 minus 129,000 is $17,000. So someone have an extra $17,000 this year if they followed my strategies or SPY. Now, the thing is, $17,000, that matters. That matters. I mean, just to give you a sense, my car, even though I'm worth millions and millions of dollars, the car that I drive is a Ford EcoSport that I bought used. That's $20,000. It's very kind of like a Warren Buffett, Dave Ramsey mentality there, right? Like I'm not, even though I have millions of dollars, I'm not splashing it out on liabilities. I'm continuing to build assets, real estate assets, stock and bond assets, crypto assets. So there's that sort of Warren Buffett Midwestern frugality there. Even though I live in Boca Raton, where everyone's dream is to drive a white Rolls Royce, I drive a Ford EcoSport. So I could almost buy another Ford EcoSport, with the difference here. So, that's Warren's quote with the smooth or lumpy. Charlie Munger goes a little bit further. Charlie Munger, being a Cerbic, being kind of a Gore Vidal of investing. Many people see him as a crank, a curmudgeon, however you want to describe it. But he views modern portfolio theory as flat Earth theory, and he hopes that the universities continue to teach flat Earth theory, so that Berkshire Hathaway can continue to outperform. So it's interesting, contrasting philosophies of academics and people that are trained as CFAs and MBAs and professionals, so to speak, are going to be weaned on modern portfolio theory. And then just really quick here, it's just an interesting, the modern portfolio theory, flat Earth society. And this gentleman here, during my time at the Berkshire Hathaway annual meeting, I was reminded that investors will be better off not wasting their time studying modern portfolio theory. I think it's interesting to study it. So when I say not wasting your time, I don't view it as I like to understand how the world works and the difference in strategies and opinions. I believe it was Aristotle, and I'm paraphrasing here, who said it was the mark of the educated mind to be able to hold two contrasting philosophies and make your own decision. So sort of to be able to accept or to study two contrasts and be able to make your own choice. And so you maybe do want to study modern portfolio theory, and you might take something from that, and then to see how Warren and Charlie at Berkshire have operated. And then I think this guy goes on about studying for the CFA. And is that worth it? Chartered Financial Analyst designation, master's degree in finance, so on and so forth. So that's just, again, the difference. And this interactive brokers look here as a perfect, in a way, contrast to the difference of sort of modern portfolio theory, that they would argue that the Sharpe ratio here would indicate that this is better. But the person who's followed this strategy has more money. So take that for what it is. But so that's pretty much it for today. I'm proud of myself that I only had to call for once throughout this about 20-minute video. A lot more comments coming in. I actually had one guy on App Harvest coming in, so I might do something on that soon. But yeah, I appreciate all the likes, subscribes, follows. I hope you all out there are staying safe and healthy. Then you had a wonderful holiday, and that Scrooge didn't visit you like he visited me, and so essentially canceled the holidays. But take care, guys. Ciao.